Hi and welcome to the channel. Today I'm going to show you 5 great dividend stocks that are on a sale. First we'll find out the dividend score, and after that we'll check the valuation with the help of fast graphs. Let's not waste any time at all. Here is the list. At 5th place we have Broadcom, a networking chip manufacturer and designer giant with a market cap of over $190 billion. They have been crushing it the last 10 years. The last year the stock price has dropped down a bit, but over a 10-year period it has actually been over 18, doubling the money. So really strong dividend score sheet, and also for the sales growth and earnings growth, this company, despite being so large, is still growing like crazy. The only negative is they didn't buy back any shares last year. But the combined dividend score at 9 out of 10 points. Let's check the valuation. Here we can see Broadcom in fast graphs, and the orange line is the earnings per share growth, and the white gray line is their dividend. And we can see that top right, their adjusted earnings growth annually is actually 32% during this period of 15 years. If we also plot the normal PE, which is about 14, together with the current stock price, we can see that it has been overvalued for quite some while, at least compared to the normal valuation of the company. But if we project out to late 2024, we can actually see an annual rate of return of 21% if the analysts are right. We can actually see if the analysts usually are right by going to the analyst scorecard. And here we can see that usually Broadcom actually beats earning about 67% of the time and hits it at 1/3 of the time, and never miss. So these predictions are very good for Broadcom. Next up, at 4th place we have Digital Realty. This is a REIT, which is a real estate investment trust, and unfortunately I don't have a dividend scorecard for them. But let's take a look at the company and how they are very important for digitalization around the globe. They operate data centers, and this is not only in the US, but actually in 6 continents, over 25 countries, and over 300 data centers. One would think that maybe Google Cloud, AWS, and Microsoft would eat companies up like this, but if we go to their first page, we can actually see that AWS, Verizon, Adobe, Google Cloud is their customers, so they are providing services for them. Let's take a look at the valuation. Here we have Digital Realty Trust, and same goes here. The orange line is the earnings per share, but for REITs we have to swap over to something called AFFO, which is adjusted funds from operation. It's quite similar for earnings per share, but for REITs. And Digital Realty Trust is growing their AFFO like clockwork. They only have some years where it didn't grow that well, but overall in this period the AFFO growth is actually 11%. If we take a look at the normal valuation, which is a bit higher at 20, combined to the current price, we can actually see why DLR is on this list. It has dropped down a lot in price the last year. It was actually peaking over $170, but now it's only trading at 101. So if we do the same with DLR, if we project out to late 2024, analyst also expects an annual rate of return of 21%, if they are right. Let's check the analyst scorecard for DLR also. Here we can see that they are very predictable, with hit 85% and beat 15% and 0 misses. So this projection is also very predictable actually. Next up at third place we have Verizon, the largest wireless carrier in the United States. They service over 130 million customers in the US, ahead of T-Mobile and AT&T. $158 billion market cap, but they haven't done that great the last 12 years. And the dividend scorecard isn't the best, but what is very good with Verizon is that it's a really stable business and the yield is crazy good at almost 7%. So if you maybe are soon retiring or retired and want some cash flow in your life, this might be a good pick for you. Let's check the valuation. Here we have Verizon in fast graphs. The orange line is the EPS, the earnings per share, and the white line is the dividend. And they are doing quite fine. They are not raising their earnings that fast as the other companies though, only about 5.7%. The same for the S&P for the 15-year back is about 7.5%. If we take a look at the normal valuation, which is very close actually to 15, and the current stock price, we can see that it has gone down a lot and now it's actually trading at a valuation of only 7. This makes Verizon a very good short-term play, even if you maybe don't want to hold the stock forever. But it has a great upside at an annual rate of return of over 43%. Let's check the analyst scorecard and see if they are any good at estimating Verizon's earnings. And here we can see that it's a bit worse. They are actually beating 8% of the time, hitting it 77% and missing 15%, but still very predictable on Verizon's earnings. At second place, we have Comcast, the largest internet cable company and ISP in US. Terrific dividend scorecard at 8 out of 10 points. And if we check the graph here, we can see that it's keeping up with S&P, but lately it has dropped off a lot. So this might be a good time to pick up some Comcast if you believe in the company long term. For the dividend score, it's 8 out of 10. It's all check marks in the yield scorecard, but the debt is a bit high and the return on capital could be a bit tiny higher also. The threshold is 12% for the return of capital. Let's check the valuation. Here we have Comcast in fast graphs, and as usual we set it to 18 years to have 15 data points for history and 3 out in the future. We can see the orange line, which is the earnings, and they are growing it extremely reliable. No big hiccups except 2020, which was an off year for many companies, but it wasn't the worst. Their earnings dropped about 17%. And top right, we can see that during this period, they actually raised their earnings by over 16% annually, which is extremely impressive. YouTube and the other streaming companies is not eating Comcast alive. They are doing quite fine with streaming servers their own and also some amusement park around the US. If we take a look at the normal PE, we can see that it's 18, and the current valuation in their stock price has dropped a lot and it's trading at under 10 right now, actually at 9. So it's going down, down, down. And if we project out to late 2024, analyst expects an annual rate of return of over 52%. So let's also see how the analysts are usually doing with Comcast in the scorecard. And here we can see the number of analysts. So it's about maybe an average 25. and usually they are beating and hitting with only an 8% miss. So analysts usually have no trouble estimating Comcast's earnings. And now for the first place for November, and it goes to HP, the world's second largest personal computer vendor after Lenovo. They are actually doubling up Apple's computer sales, so they are selling quite a lot of computers and other services and systems. We can see during the last 10 years they are beating the S&P 500 with quite a margin, that with a bit more volatility though, so you have to have a bit strong stomach compared to the index. And if we can look at the dividend scorecard here, we see very nice earnings. The future might be slowing down a bit, extremely good return on capital, same goes with their debt, and now a nice dividend yield of over 3.5%. Let's check the valuation. Here we have HPQ in fast graphs. The orange line is the earnings. They had a bit of a stagnant period 2011 to 2015, but after that it's actually booming again. And of course 2020, 2021, a lot of people was working from home, new computers, so it was a bit of a boom, and we can see that it's actually estimated to go down a bit 2023. No wonder why, but it's still a nice projection up for the EPS. And during this period we can see an adjusted earnings growth rate of over 12%. And if we plot their normal PE, which is about 16, and now the current stock price, we can see that it's trading way under its normal valuation at a PE of about 7. So if we project out to late 2024, analyst expects an annual rate of return of over 55%. Let's check also how the analysts usually are estimating HP. And here we can see, unfortunately, analysts are missing a lot on HP's estimations. But lately though, it has been all beats. So they had some trouble up to 2015 with a lot of overestimations, but now lately, the last 5 years has actually been beats. Please hit the like button and also watch my latest video where I reviewed a subscriber portfolio. See you soon!